Welcome to the deep dive. We take the information you send us, dig into it, and pull out the crucial knowledge you need. Basically, we're your shortcut to understanding what really matters.
And today, we are diving deep into a classic, Stan Weinstein, Secrets for Profiting in Bull and Bear Markets. It actually came out in Spanish first. Los secretos para ganar dinero en los mercados alcistas y bajistas, way back in 91.
Right, 91, with the translation by Chesma Vasa and technical direction from Antonio Saiz del Castillo. So what's the core aim of this book?
Well, it's really about teaching readers, teaching you how to spot technical signals in a stock cycle. And then, crucially, how to use that knowledge for buying, selling, even short selling. Plus, he shows how these ideas apply to mutual funds, too.
Okay, so our goal here in this deep dive is to unpack those practical insights, help you understand market cycles, maybe improve your timing without getting, totally swamped in jargon.
Exactly. Let's jump right in. One of Weinstein's foundational ideas is the importance of technical analysis. Often, he argues, over fundamental analysis.
He's pretty direct about it, isn't he? That phrase.
A look at the chart is worth 1,000 predictions. That's his mantra, basically. He thinks the price action tells you almost everything you need to know.
And he uses examples, right? I remember reading about General Motors.
Yeah, GM in 81, profits were improving, fundamentals looked okay, but the stock, it went down significantly.
And the flip side, Greenwich Pharmaceuticals.
Right, between 86 and 87, the company was losing money, but the stock price, well, it soared.
So the point for our listeners is...
The point is what Weinstein calls the tape tells all. If you learn to read the price action, how the price is moving, and the volume, how many shares are trading, you can often get in sync with the smart money, the informed traders, sometimes even before the fundamental news catches up. It can give you earlier signals.
So for listeners maybe used to poring over balance sheets and income statements, that the fundamental stuff, Weinstein's saying, hey, look at the chart. It might give you a quicker, more actionable heads up.
Precisely. And that really leads us into the heart of his method, stage analysis. His 4 stages of a stock cycle.
Okay, let's break those down. The 4 stages are...
Stage 1 is the base area. Stage 2 is the advancing stage. Stage 3, the topping area. And stage 4, the declining stage. Think of it like a stock's life cycle.
Got it. Stage 1, the base area. What's happening there?
Okay, so this usually comes after a stock has been in a downtrend. Stage 4. The selling pressure starts to ease off, the downward momentum slows, and the stock begins trading. Well, sideways, in a range.
Like it's catching its breath.
Kind of. Buyers and sellers are reaching a sort of equilibrium after the sellers were totally in control. For you, the listener, this sideways churn signals the potential end of the decline, maybe the start of something new.
And what are the clues? How do you spot a stage 1 base forming?
Well, typically volume tends to dry up as the base forms. Less selling pressure, less excitement. But then, and this is interesting, towards the end of stage 1, you might see volumes start to pick up again, even if the price isn't really going anywhere yet.
So, volume increasing, but price flat. What does that mean?
It often means buying interest is starting to absorb the remaining selling. Like accumulation is happening quietly. For you, that's a subtle sign, an early hint of a potential move higher. It's about spotting those potential entry points before everyone else piles in.
Okay, makes sense. So the stock's been basing, moving sideways. What triggers the move into stage 2?
Stage 2, the advancing stage. This is the one everyone likes. It kicks off when the stock price breaks decisively above the resistance level of that stage 1 base. That price ceiling it kept hitting.
Right.
And crucially, this breakout should happen on increasing volume. That confirms that buying interest is real and strong. Also, the 30-week moving average, basically the average price over the last 30 weeks, it smooths out the noise.
Shows the trend.
Exactly. That moving average starts to trend upwards and the stock price stays consistently above it. So the takeaway for you is breakout plus volume plus rising 30-week MA, probable uptrend starting.
And Weinstein says this is the time to buy.
This is the prime time, according to him. Stage 2, you've got confirmation. The stock proved it could break resistance. The trend is turning up. Waiting for this setup, he argues, really improves your odds.
Okay, stage 2 is the fun part. But trends don't last forever. What about stage 3, the topping area?
Right. After a good run-up in stage 2, the stock might start moving sideways again. Looks a bit like stage 1, but there's a huge difference, the volume. In stage 3, volume is often very high, and the price action gets really volatile, choppy. Weinstein calls it churning.
Churning. Sounds messy. What's going on under the surface?
It's basically a big fight. You've
Huh.
got new buyers coming in, maybe attracted by good news or analysts finally upgrading the stock after the big move.
Latecomers.
Often, yeah. And they're meeting the early investors, the ones who bought in stage 1 or early stage 2, who are now thinking, maybe it's time to take some profits. So, lots of shares changing hands, but the price isn't making sustainable progress upwards.
So that high volume churning is a warning sign.
It could be a major warning sign. It suggests the uptrend is losing steam, the buying power is being met with equal or greater selling power. A potential reversal could be brewing.
Okay, so the battle ends, and sometimes the sellers win. That brings us to the not-so-fun stage 4, the declining stage.
Yeah, stage 4. This starts when the stock breaks below the support level it formed in stage 3. The price floor it was bouncing off.
Right.
And just like the moving average turned up for stage 2, now the 30-week moving average starts to trend downwards. The stock price stays mostly below it.
And the pattern of the price itself.
It's characterized by lower highs and lower lows. Every little rally attempt fails to get back to the previous peak, and every sell-off pushes the price to a new low. The trend is clearly down. What used to be support now often acts as resistance on bounces.
Sounds like a place you don't want to be holding the stock.
Definitely not. Weinstein's warning is stark. Don't try to catch a falling knife. Buying in stage 4, hoping for a bottom, is usually a losing game. The odds are against you. The takeaway: recognize stage 4, get out. Or, for the more experienced, maybe even consider shorting. We'll get to that.
Okay, so we understand the stages. How do we translate this into practical buying? When's the sweet spot to enter a long position?
The ideal time, Weinstein says, is right when that stock breaks out of its stage 1 base, pushes above that resistance level, and it's trading above a 30-week moving average that is either flattening out or, ideally, already starting to rise.
So you wait for that confirmation, the move into stage 2.
Exactly. Wait for the breakout into stage 2. Don't try to perfectly time the bottom of stage 1. Wait for the market to prove the trend is changing.
And he suggests a specific way to actually place the buy order, right? Something about automation.
Yeah, he's a fan of buy stop orders. You tell your broker, okay, buy stock XYZ, but only if it trades at or above, say, $12. You set it just above the resistance level.
So you don't have to stare at the screen all day waiting for the breakout.
Precisely. It automates the entry at that key technical point. He does add a little caution, saying it might not work perfectly for all NASDAQ or OTC stocks, but the principle is sound. It helps enforce discipline.
Okay, but it's not just about finding any stock breaking out, is it? He has this broader approach.
Oh, yeah.
The forest to the trees thing.
Oh, yeah, this is crucial. It's a 3-step filtering process. First, the forest. What's the overall market doing? Weinstein is adamant, don't be a hero. If the general market trend is down, like in stage 4, your odds of picking winning stocks are much, much lower. Only consider buying if the market itself is healthy, ideally in a stage 2 uptrend.
Step 1, check the market weather. Got it. What's step 2?
Step 2 is the strong neighborhoods within the forest. Sector strength. Focus on industry groups that are technically strong. Why? Because a strong stock in a strong sector is way more likely to outperform than even a strong stock stuck in a weak sector, or rising tide lifts boats, but especially the best boats in the fastest currents.
How do you find strong sectors?
He suggests tracking things like the percentage of stocks on the NYSE that are in stage 1 or 2, or looking at sector charts, like those from Standard & Poor's, using the same stage analysis principles.
Okay, market's good, sector's good. Now step 3.
Step 3 is finally looking at the individual trees. Stock selection. Now, you drill down within those strong sectors and look for the best individual stocks that are showing solid stage 1 bases and look ready to break out into stage 2.
So it's like stacking the odds in your favor. Market, sector, stock.
Exactly. It's a probabilistic approach.
Yeah.
You're putting yourself in the highest probability situations.
And when you're looking at those individual stocks, relative strength comes into play, right? How does that work?
Big time. Relative strength just compares how a stock is performing relative to something else, usually the overall market like the S&P 500 or the Dow. You want stocks that are outperforming the market.
He had that example, didn't he? If a stock is up 20%, but the market's up 25%.
Yeah, that stock actually shows weak relative strength, even though it went up. You ideally want stocks that are leading the pack, going up more than the market average. Those are your potential leaders.
And the breakout itself, it needs conviction, right? Volume again.
Volume, volume, volume. Weinstein hammers this home. A breakout above resistance must be accompanied by a significant increase in trading volume.
What if it's not? What if it just sort of drifts above resistance on low volume?
Big red flag. That suggests there isn't broad buying enthusiasm behind the move. It's much more likely to be a false breakout, a head fake,
Right.
where the price quickly falls back below resistance. Strong volume validates the move.
Okay, so stages, buying criteria, the filtering process. How do we pinpoint the really good setups, the A-plus trades he talks about?
Right, refining the process, he looks for extra confirming factors. One is overhead resistance. Ideally, you want a stock breaking out with very little or even no historical resistance above the breakout point.
Meaning fewer sellers lurking at higher prices from previous failed rallies?
Exactly. Less baggage. He even mentions looking at long-term charts, like a 10-year Mansfield chart, to find stocks breaking out to new all-time highs. Those have clear skies above them, theoretically.
Makes sense. What else makes for an A-plus setup?
That relative strength line we talked about, it needs to be cooperating. When the price breaks out, you want to see the relative strength line also breaking out, or at least strongly trending up, confirming the stock is outperforming as it makes its move.
And if it doesn't, if price breaks out but relative strength is lagging or going down.
That's called divergence, and it's another warning sign. It suggests the breakout might lack underlying strength compared to the market. He uses ACU as an example of a good setup where price and relative strength move together.
Okay, and then there's the triple confirmation pattern. Sounds powerful.
It is. This is like the gold standard setup for him. It's when you see three things happening, ideally within the stage 1 base, just before or during the breakout. First, really strong volume expansion showing big interest. Second, the relative strength line turns positive after being negative or neutral. And third, maybe some volatile price action within the base itself, suggesting a buildup of energy.
Like a coiled spring.
Kind of, yeah. He uses Anthony Industries as an example. When you see all three of those line up strong volume, improving relative strength, and maybe some pre-breakout volatility, it suggests a very high probability that the subsequent stage 2 move will be powerful.
All right, we know how to potentially find and enter winners, but nobody's right all the time. We need to talk about protecting capital, taking profits, the selling side. He starts with some don'ts.
Yeah, it does. Some common psychological traps. First, big one. Don't hold on to a losing stock just because you don't want to pay taxes on a winner you sold, or because you hope to avoid realizing the loss for tax purposes.
The tax tail wagging the investment dog.
Exactly. Letting a small loss turn into a huge one just to defer taxes is usually terrible math. Second, don't cling to a falling stock, stage 4, just because it pays a good dividend. He mentions Rochester Gas and Electric.
Right, the dividend appeal.
Yeah, but the price decline can wipe out years of dividend payments fast. And there's always the risk the company cuts the dividend anyway if things get bad enough. Price action comes first.
So forget taxes and dividends as reasons to hold losers. What should drive selling?
Discipline, and specifically sell stop orders. He strongly recommends using them, usually good till canceled, TDC, to set a floor below your purchase price. If the stock drops to that level, you're automatically sold out, limiting the damage.
So it takes the emotion out of cutting a loss.
That's the idea. Predefine your pain point. He notes slight differences, direct stops on NYSE, maybe stop limit orders on Amex NASDAQ, but the principle is the same. Protect your downside.
Okay, that's for cutting losses. What about protecting profits when a trade works? We don't just leave the initial stop in place forever, do we?
No, definitely not. That's where trailing stop losses come in. As the stock moves up nicely in stage 2, you want to progressively raise your sell stop level behind it.
How do you decide where to raise it?
Weinstein suggests a couple of guides. After the stock has a decent run and then pulls back a bit like a normal correction, maybe 8–10%, and then resumes its climb towards the old high, you can raise your stop under that recent pullback low. You can also use the rising 30-week moving average as a dynamic guide, keeping your stop somewhere below that.
So you're locking in profits as it goes, but still giving it room to breathe.
Exactly. You're trailing the move up, protecting more and more of your gains automatically.
Are there times to be more aggressive with raising that stop? Signs the trend might be weakening.
Yes. A key sign is when that 30-week moving average, which had been trending up nicely, starts to flatten out. That suggests the upward momentum is slowing down. When you see that flattening after a good stage 2 run, Weinstein says become more vigilant, tighten your stops. A break below a flattening MA is a bigger warning.
He also uses trend lines for selling, doesn't he? How does that fit in?
Right, trend lines. Drawing a line connecting the significant lows in an uptrend. If a stock breaks below a well-established uptrend line, especially one that's held multiple times,
That's a sell signal.
it's often a signal to at least consider selling, or maybe sell a portion of your position. You could sell half on the trend line break and then keep the other half with a regular stop below a recent low with a 30-week MA. The longer the trend line and the more times it's been tested, the more significant the break.
Any other rules of thumb for taking profits? I think I remember something about a percentage gain.
Yeah, the 10% swing rule, it's not a hard and fast rule, but he suggests that once a stock moves about 10% above your initial breakout buy point, you might consider selling part of your position, maybe half.
I do that.
It locks in some profit quickly, reduces your overall risk on the trade, and can make it psychologically easier to let the rest of the position ride for potentially bigger gains. Take some pressure off.
Okay, one more selling scenario. What if you buy a breakout, it looks good, but then it just fizzles, doesn't follow through, or worse, drops back below the breakout point?
Failed breakouts. Yeah, Weinstein says act decisively. He uses American Capital Management and Rollins Environmental as examples. If a stock breaks out of stage 1, but doesn't show strong upside momentum fairly quickly, or if it falls back below the breakout level.
Oh.
Yeah, that's a sign the breakout isn't working.
Right.
His advice, lighten up immediately, reduce your position size, and use a very tight stop loss just below that breakout level. Don't let a failed breakout turn into a significant loss. Cut it quick.
Makes sense. Cut your losses quickly, let your winners run, but manage the risk on the winners too. Okay, we've covered buying and selling in uptrends, but the book title mentions bear markets too, short selling.
Right. Profiting when stocks go down. It can seem intimidating, but Weinstein gives clear guidelines. First, what not to do.
The nose of shorting.
Exactly. Don't short a stock just because its price-to-earnings ratio seems really high. He uses Data General as a case study high PE, but it kept going higher for a long time. Valuation alone isn't a timing tool.
What else?
Don't short a stock just because it's gone up a huge amount very quickly, those sweetheart stocks. They often attract a lot of short sellers, meaning there's a high short interest relative to daily volume.
Which makes them risky how?
It makes them prone to a short squeeze. If good news hits, or buyers just push the price up, all those shorts are forced to buy back their shares to cover their position, which creates even more buying pressure, setting the stock rocketing higher. Very dangerous for shorts.
Okay, so avoid shorting based only on PE or because it's a high flyer. What should you look for in a good short candidate?
The ideal setup is basically the mirror image of a good buy setup. You want stocks that are clearly in stage 4. That means trading below a declining 30-week moving average.
Trend is down.
Trend is clearly down. You also want to see a declining relative strength line, meaning the stock is underperforming the market. And ideally, the stock should be in a technically weak sector or industry group.
So again, stacking the odds. Weak stock in a weak sector in a weak market environment.
That's the highest probability short setup. He shows examples in graphics 716 and 717, multiple technical factors pointing down.
And the entry point for a short. When do you pull the trigger?
You're looking for breakdowns below key support levels, typically after the stock has formed a stage 3 topping pattern. Just like you buy breakouts above resistance, you short breakdowns below support.
Any specific patterns to watch for?
The classic head and shoulders top formation is a big one for short sellers. When the stock price breaks below the neckline of that pattern, it's considered a strong confirmation of a reversal and a potential short selling opportunity.
And risk management is just as important for shorts, maybe even more so.
Absolutely. Since a stock can theoretically rise infinitely, the risk on a short is technically unlimited. So just like you use sell stops on longs, you must use buy stop orders on shorts.
To limit the damage if you're wrong and the stock goes up?
Exactly. Place an initial buy stop above a key resistance level when you enter the short. Then, if the stock does decline as hoped, you methodically lower that buy stop level, trailing the price down to lock in profits on their short position. Same principle as trailing stops on longs, just in reverse.
Okay, that covers individual stocks, long and short. But Weinstein also looks at the bigger picture, right? Using market indicators for overall timing.
Yes, he dedicates a good chunk to long-term market timing. He looks at several indicators. One is the NYSE Advanced Decline Line. It's a running total of the number of stocks advancing minus the number declining each day.
What does that tell you?
It measures the breadth of the market move. If a major average like the Dow is making new highs, but the AD line isn't confirming, meaning fewer stocks are participating in the rally, that's a negative divergence and can be an early warning sign of market weakness.
Interesting. What else?
The Momentum Index, or MI. It's usually a 200-day moving average of those daily advanced decline figures. Big signals can come when the MI crosses the zero line after being way up in positive territory or way down in negative territory for a while. He especially notes that bearish signals, when it crosses below zero after being high, are often very significant.
So it measures the market's internal momentum.
Kind of, yeah. He also looks at weekly new highs versus new lows on the NYSE. Seeing lots of new highs confirms strength. Seeing new lows expand warns of weakness. And he even suggests using stage analysis on a bellwether stock like General Motors as a sort of proxy for the overall market trend.
Using GM as a market indicator.
As a confirmation tool, yeah. And finally, he discusses the price-dividend ratio, PD, for the Dow Jones Industrial Average, looking at the Dow's price relative to the dividends it pays.
How does that help?
Historically, very high PD ratios, say above 26 or 30, have often coincided with market tops or overvalued conditions. Think 1987, when he notes it was near 40. And very low PD ratios, maybe below 14 or 17, have often marked market bottoms or undervalued conditions. It's a long-term valuation gauge.
Wow, quite a toolkit for gauging the market's health. He also talks about contrary opinion. What's his take on that? It's not just about doing the opposite of the crowd, is it?
No, it's more subtle than that. True contrary opinion, in Weinstein's view, isn't just disagreeing with whatever the popular view is today. It's about waiting until a certain belief becomes almost universally accepted, like everyone knows this is true, among experts and the public alike. That's the point when a real contrarian starts to seriously question if that consensus might actually be wrong.
So it's about recognizing extreme sentiment when an idea becomes almost dogma.
Exactly. When there's near unanimity, that's often when the market is most vulnerable to a surprise in the other direction.
Okay. Now, a lot of listeners might invest through mutual funds rather than individual stocks. Does Weinstein say staged analysis works for funds too?
He does. He says the principles apply quite well. The strategy he outlines is pretty straightforward. Buy into more aggressive growth funds when the overall market confirms a stage 2 uptrend. Fund price moves above its 30-week MA after basing.
And on the flip side?
When the market rolls over into a stage 4 downtrend, get defensive. Switch into money market funds to preserve capital. You can't use actual stop orders on mutual funds, so he talks about using mental stop losses, having a predetermined exit point in mind.
What about sector funds?
Same idea. If you're using sector funds, relative strength becomes really important for choosing which sector fund to buy if several are breaking out around the same time. Pick the one showing the strongest relative performance. So yes, the stage analysis framework is definitely adaptable to funds.
Good to know. He also briefly mentions options and futures.
Just briefly. He flags them as much higher risk instruments, really for experienced traders. His main point there is, even with these derivatives, rely on the charts, the technicals, much more than trying to trade the news or fundamentals.
Got it. Approach with caution. So as we kind of pull all this together, what are the absolute core takeaways from Weinstein's philosophy that listeners should really latch onto?
I think there are a few key ones. Number one, never ever hold a stock, long or short, without a protective stop loss in place. Risk management is paramount.
Non-negotiable.
Absolutely. Two, don't be afraid to short sell in a confirmed stage 4 downtrend, but always use that buy stop for protection. Three, stage analysis isn't just for stocks. It's a framework you can apply to sectors, markets, funds, potentially other assets too.
And maybe one more.
Yeah, a big one. It's usually better and safer to buy a stage 2 breakout, even if you feel like you're a little late, than it is to try and be a hero and perfectly time the absolute bottom of a stage 4 decline. Wait for confirmation.
So that's our deep dive into Stan Weinstein's secrets for profiting in bull and bear markets. Hopefully that's given you, our listener, some really practical tools for thinking about market stages and maybe refining your own investment approach.
Yeah, and as you digest all this, here's something to think about. Applying Weinstein's 4 stages, where do you think the overall market is right now? Or maybe a specific stock or fund you're watching closely. Where does it sit in that cycle, and what might Weinstein's framework suggest about it?
That's a great question to ponder. We really encourage you to reflect on these ideas, maybe even dig into the book itself if this sparked your interest. If you have more thoughts or questions for a future dive, let us know. Thanks for joining us.